Markets flashed a golden cross on the S&P 500 in the past day, where the 50-day MA overtook the 200-day MA. This technical signal historically precedes a bullish run. Traders immediately scanned their portfolios for sectors to overweight. Hedge funds responded, rotating capital into energy and industrials today. The mixed session shows markets taking signals seriously but staying cautious. The S&P closed down 0.1% amid the golden cross momentum. The Nasdaq slid 0.8%, while the Dow surged 0.9%. Rotation into value and cyclicals outweighed tech weakness. Oil and industrial stocks led the advance as investors dialed exposure. This shift reflects shifting sentiment toward real economy sectors. The divergence between indexes highlights active asset allocation. Oil prices steadied around $67 per barrel following mixed U.S. crude inventory data and OPEC Plus supply discussions. U.S. stockpiles increased by 680,000 barrels, yet traders showed restraint. The market awaits formal OPEC guidance before taking a definitive move. Energy equities rebounded on expected policy stability. The pause in prices signals consolidation with potential volatility ahead. Gold futures jumped between 0.4% and 0.7%, demonstrating hedge flows returning amid macro uncertainty. Financial institutions increased short-term gold holdings. This rise happened concurrently with equity rotation, showing investors dual bets. Gold is acting as a strategic tail insurance. The uptick signals tactical repositioning across portfolios. Bitcoin held between $105,000 and $107,000 after a dip, supported by renewed institutional ETF purchases. Crypto firms reported higher inflows this week. Analysts relate the bounce to ETF liquidity dynamics. Regulatory clarity in Europe also contributed to sentiment. It shows crypto is no longer fringe, it's interwoven with broader finance. A BIS warning on stablecoin systemic risks rattled markets. Circle's stock dropped about 15%. Regulatory scrutiny is increasing globally. Markets digest implications for broader crypto infrastructure. Stablecoins are under microscope, impacting DeFi confidence. Investors are watching central bank responses closely. President Trump convened a White House Situation Room session on Iran-Israel tensions, triggering a 300-point intraday drop in the Dow. Geopolitical shocks are back in market focus. Recovery followed as risk appetite returned. Investors now price in geopolitical risk hedges like gold and defense stocks. The episode reminds markets remain reactive to global events. Federal Reserve's Powell emphasized that rate decisions will depend on tariff impact and incoming macro data. The Fed hold policy tight amid global uncertainty. Markets view September as the next cut timeframe, but only if data supports it. Traders now monitor inflation prints and trade balances. Fed speak continues driving asset pricing. The U.S. dollar sank to a 3.5-year low, down over 10% year-to-date, pressured by dovish Fed signals and rising fiscal stimulus. Currency markets are reflecting shifting monetary policy. Trade-weighted indexes hit fresh lows. Participants expect the euro and other currencies to gain further. The currency incline feeds into global asset allocation decisions. Treasury futures now reflect 20% chance of July cut, but September's more likely for rate reduction. Yield curves have flattened marginally. Bond traders digest mixed signals from Fed commentary. Market expectations center on a gradual policy pivot. Fixed income volatility remains low, but poised to shift when labor data drops. Microsoft announced around 9,000 job cuts due to AI restructuring plans. Its stock dipped. The market reacted with broader tech pullback. Shares stabilized as analysts projected cost savings. Investors are weighing tech profits versus structural risks. The job cuts highlight the evolving nature of global technology firms. Tesla rebounded 4.3% following mixed delivery numbers in Europe, defying EV concerns this week. Investors cheered the performance despite long-term policy risk. European delivery beat low forecasts, easing worries temporarily. The stock's volatility underscores sensitivity to regional dynamics. EV investors remain watchful of subsidy policy shifts. Tesla faces fresh EV subsidy threats after Trump spoke of possible revocation in executive orders. Subsidy risk is influencing global EV valuations. Market participants are pricing in regulatory uncertainty. EV sector sentiment is now more nuanced. Trading ranges widened accordingly. Asia's Nikkei surged thanks to fresh BOJ stimulus moves, delivering Japan its strongest Q2 performance since 1990. Capital inflows strengthened. Export and tech stocks participated broadly. Tokyo is emerging as a key beneficiary of global rotation. Markets are adjusting EM exposure accordingly. China's manufacturing PMI contracted for the third straight month, showing slowed export demand and domestic weakness. Markets digest macro headwinds. Beijing is expected to announce fresh stimulus measures. Equity markets remain volatile on policy chatter. Investors monitor any stimulus pipeline closely. Australia's ASX 200 neared record highs, even as consumer discretionary stocks lagged. Mining and commodity shares underpinned performance. Local consumer weakness signaled diverging trends. Investors reallocate based on regional sector strength. Resource-driven growth continues to support Australian equities. Emerging market debt issuance totaled a record $190 billion in the octane, with issuers issuing bonds in euro, yuan, and pounds versus dollars. De-dollarization accelerates. Global lenders note diversification trends. Investor appetite for EM debt remains strong. Dollar reserve shifts accompany the trend. Global central banks increase holdings of gold, euro, and yuan in official reserves. The shift signals broader asset allocation strategy. De-dollarization is evolving from talk to action. Reserve portfolios reflect long-term currency trends. This is reshaping global financial architecture. The euro rallied to $1.1808, strengthening year-to-date by Pigdalai 14%, though ECB officials caution that inflation remains sticky. Eurozone bonds repriced accordingly. Pan-European yields rose. Currency strength exacerbates export pressures. Europe remains conflicted between inflation and growth. UK government bond yields jumped as gilt yields dispersed after fiscal policy worries. BOE officials discussed potential need to cut rates below 3% due to economic slowdown. Bank officials signal mixed policy tools ahead. The UK curve remains steep. Markets brace for central bank clarity.